just before we check on how markets in the region closed trading yesterday, we'll take a look at the Nigerian consumer goods space with keen focus on PZ and Unilever as the market awaits more earnings to come through in the sector. Now, according to CSL stockbrokers, after recent quarters of disappointing results reports by Unilever Nigeria, the company appears to have regained some momentum. We'll review the case made for this stock and similar ones with Tayo Oyegole, equity research analyst at CSL Stockbrokers. Well, thank you so much, Tayo, for joining us.
Hi, good afternoon, Sarah. Good morning.
Well, let's talk about two stocks that we're focusing on, PZ and, of course, Unilever, but with a focus on PZ, looking at the drivers behind its half-year result, where we saw sales up 10% year-on-year, of course, boosted by an increase in patronage in its personal household products. Now, give us your own thoughts on the key drivers behind Unilever's half-year results.
Okay, thank you, Sarah. I think, in my opinion, is impressive. Given the facts that the last 2 quarters have been pretty slow, likely due to tensions in the north. So, I think it's an exciting sales growth we saw there. This was driven mainly by the household and personal care division, which recorded growth of around 11% compared to the foods division, which recorded single-digit growth. Checking through the books, a higher depreciation charge for the household and personal care segment suggests to us that the company is investing, making higher investments in this division, which is a likely explanation for the faster growth we have seen. So on the balance, we think that the growth numbers are impressive for sales.
Well, let's talk about the spike in interest expense. According to your report, that's a key concern for you. A 59% spike in interest expense, of course, that came in at 497 million now. Well, you say the company has an increased debt burden, of course, owing to some loans that it took, and of course, from dwindling operation cash flows. What's the implication for this?
Basically, I think it is material because as at the end of 2011 or beginning of 2012, so to say, the company had almost zero debt exposure, but today debt stands around 8.6 billion naira, which is very material. We believe that the increased debt is being used to support working capital and probably support its expansion programs. Interest is a key concern because this weighed on profitability in the quarter, and then it's looking like the company's ability to manage interest expense is going to determine the direction of profit and profit margins in the coming days. So we'll be looking, to see how the company, copes this rising interest expense in the coming days.
Well, it looks like the company paid close attention to its household and personal care division. That's where we saw sales jumping about 10% year-on-year. Do you think this focus will continue, or they might actually look at other areas?
Yeah, there are just 2 areas, household and personal care. Margins are higher for this section. So I think it makes, it's a more efficient decision to invest, in the higher margin business and a business which is growing faster. So I think it makes, economic sense for us.
Okay, let's quickly move on to PZ. What are your expectations for its half-year result? We've seen that of Unilever, not too bad, but for PZ, what are your expectations?
Yeah, we expect slower growth for PZ. We're looking at year-on-year growth in the region of 3 to 5%. I think the big story for us here is the margins expansion, which we have seen in recent quarters. Now, the company is embarking on a program called Supply Chain Optimization Program, or a margins expansion program. I think this has, paid off in recent quarters. So we think that this is a key initiative, and we're going to see the effects trickle down into the next quarter. And then its recent completion of its refinery in conjunction with Wilma is also key. We believe this is going to help it mitigate the pressures of forex and global prices of oil palm in the local market. So we expect that these 2 key initiatives will help boost its margins. We're looking at margins expanding into double digits. That's profit margins, profitability, PBC and PAT margins expanding into double digits in the next 2 years from the low 2-3%, 2 years ago.
Tayo, a quick one before I let you go. What's your sell recommendation for this stock?
Come again, please.
Your recommendation for this stock: sell, buy, hold?
It's a sell. It's a sell. I think the company is basically overvalued at the current price, trading around 51 times our 1 year forward earnings, and we think this is pretty expensive.